Silver and gold continue showing strength as both historic monetary precious metals busted through some psychological price barriers this week. Recording this on Thursday evening, August 8, 2019, a night before the week's trading ends, silver spot price is hovering around $17.10 an ounce in fiat US dollars. The gold spot price is pricing this evening around 1,507 fiat Federal Reserve notes per troy ounce. Looking at the Silver Doctor's website poll this week, it appears 75% of those who responded to the poll do not believe the silver spot price will close this week above $17 per troy ounce. It'll be interesting to see if the crowd has been correct or not. Either way, both metals are trading strongly this summer. As for the gold-silver ratio, we are still at the 88 level. It remains to be seen if silver is going to take a breather before a run higher in value versus gold to come. This week, we welcome back a returning guest, Mr. Ronnie Stoeferle of the In Gold We Trust report. We speak about the disconnection between stock price inflation and silver prices, as well as various other long-term macro charts and precious metal matters, when we return from the short message from our show's sponsor. SD Bullion is a high-volume, physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. At the bottom right section of our website, you can also easily subscribe to our weekly bullion deals mailing list, where you will receive weekly notifications of valuable product deals that may be exclusive only to our SD Bullion mailing list. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week's returning guest, he is a co-founder of the annual In Gold We Trust report from Incrementum AG. It's Mr. Ronnie Stoeferle. Mr. Ronnie, thank you for coming back on our show.
You don't have to call me Mr. Ronnie. You can say Ronnie. Hi, James.
How we doing, man? Everything good?
Very good.
Good.
Very good. How are you?
Good. So Ronnie, we had tried a couple times, and it was much to my demise. I didn't do a couple things when it came to scheduling, and I missed a couple of attempts to try and speak with you earlier in June. But since you've been on vacation for a little bit and been away from the desk for a while, I wonder, having a little bit of perspective and break up from the day-to-day stuff that happens typically when you're working day-to-day. I mean, if you have like 30 days away from the desk, sometimes you come back with a little bit different of a perspective. I wonder if there's anything that kind of comes to mind right away because you're just getting back from being away from the desk. I wonder if there's something that stands out to you.
No, actually, it was a pretty good confirmation of the stuff that we wrote in our last In Gold We Trust report. It was quite a brick with 340 pages. But the main takeaway was, and the report was published end of May, the main takeaway was, okay, if we go above this massive resistance zone at 1360, 1380, then we will see momentum kicking in. Then we will see institutional players entering the market. And that turned out pretty well. And we shouldn't forget that in July, the US dollar was extremely strong versus most currencies. And gold held up extremely well, and we've seen, of course, it was overbought. We've seen pretty big volumes also in the ETFs, which shows you that there's institutional investors now really coming in. But gold held up really well and defended this breakout level. So basically that confirmed our assumption that there is a big macro regime shift happening, that central banks are doing this, what we call the monetary U-turn, that also equity markets are probably in the process of topping out, and that gold is in the early stages of a new bull market.
So I went through this incredible 350-page report that you guys created, and I also hear that you've translated it into Mandarin for simplified Chinese, so people in China can see
Yeah.
it as well, which is very impressive. I've tried. I've done that before in some of the content we've created, and it's not simple to translate. What you're writing into other languages. So
Yeah. Yeah.
kudos to you guys for doing all that
Thanks.
work. We dug out about 5 slides to kind of cover today, just to get people a little bit of an idea of what's inside of the free report. So I believe the first slide I dug out was an interesting slide to me. It was showing, it's a graph showing the S&P 500 versus the gold and silver ratio inverted. And this is, looking at the chart. This chart goes back to 1990 to today. And this is the first time we've ever seen this huge decoupling, it seems. Obviously, the gold-silver ratio has dropped a little bit since this chart was printed, but it hasn't dropped precipitously much. And same with the S&P. The S&P is still near record highs. So I wonder what you're thinking in terms of, what's caused this maybe, and then secondly, when this reversion occurs, I mean, you would expect it. I mean, for 30 years, this roughly had not been the case, or maybe 25 years. So I wonder what your thoughts are on the chart.
Yeah, well, I think in this environment that we're living, where there's such a massive intervention happening in asset classes, in primarily in the interest rates. I think it's all those things that you learn in your CFA and in business school and whatever. All those theories, they don't work anymore. So for us, it is more important to follow relative price developments. So we work quite a lot with ratios, and the gold silver ratio, for example, is a very, very important ratio for us. We also use that in our incrementum inflation signal, and normally when inflation rises, the gold silver ratio should be falling. So that means that silver outperforms gold. Now, what we're seeing since 1990, and you can see that on the chart, that it was basically a synchronized development between the gold-silver ratio and the S&P 500. But since 2011, that basically broke 2011, 2012. So we don't see that very strong correlation anymore. And our interpretation for this phenomenon is that in previous economic cycles, the reflation was usually achieved with expanding credit. And this kind of broke during the GFC and afterwards. And now it seems that the reflation shall be achieved by buying securities, which made, of course, asset price inflation, which made monetary assets more expensive, but didn't have any strong impact on consumer price inflation yet, I have to say. And I am not only born in Austria, and I'm very much influenced by the Austrian School of Economics. And Murray Rothbard once wrote about the 3 stages of inflation. He said, first of all, there's monetary inflation. Okay, we've seen that big time. Then there is asset price inflation. We are seeing that big time. And then the 3rd stage only is consumer price inflation. So I think this is a really, really, really nice basically line out for what might happen. And we are writing in the report, probably rising inflation is the most contrarian view that you can have at the moment. We've seen this cover by Bloomberg Business Week, I think it was, that inflation is dead. Right. We're seeing that now 13 trillion of bonds are trading at negative yields. And of course, what's the biggest pain trade for those 13 trillion? It is rising inflation. So from my point of view, we should not underestimate the inflationary forces that are already below the surface and that might come out sooner than later. And from my point of view, also due to the base effect, for this year at least, we will see rising inflation numbers. And I think, if we're seeing the stuff that's going on at the moment in Iran, but also some other political developments, like in Hong Kong, for example, something that I'm following very closely. I think those things could be some sort of a trigger for higher inflation. And as I've said, the inflationary forces below the surface are already pretty strong, and at some point they're gonna come to the surface.
Thank you for that. So moving on, we dragged out one other chart. This chart, everyone I think has seen a lot. I've actually seen, for instance, some of them that are more recent. They drove back. Typically, when you see this chart, it goes back to like the beginning of the full fiat currency era to 1970. But this one was really great because you guys pulled it all the way back to 1900. So it's a 120-year chart of basically the Dow Jones average ratio versus the Goldman Sachs commodity index, I believe, is what you're using here. So it's measuring whether or not commodities are underpriced or overpriced compared to, for instance, the Dow Jones or other U.S. stocks, right? So obviously we're hitting levels again that were only hit during the 1960s roughly, and then as you rolled over into the 1970s into stagflationary economy, obviously commodities not only got to like what the median value should be, but obviously overshot and went far radically higher. So I'm guessing we're looking at somewhat of a repeat. If you are feeling like potentially inflation is something that we're going to see in the coming decade, it's quite possible we could see a similar repeat almost of a stagflationary 1970s. Am I putting words in your mouth, or is that am I getting the right idea from you? I think.
Yeah, absolutely. And I mean, I sometimes think that we're already in some sort of stagflationary environment because, over here in Europe, growth numbers are really, really anemic. They're very, very low. And in the US, of course, you've got massive fiscal stimulus. So growth, I don't know, 1.5, 2%. But then, we all know that official inflation numbers and real inflation numbers are pretty divergent. So if you say that the real inflation that people can feel plus asset price inflation, that it's significantly higher, you could also say, okay, perhaps we are already in a stagflationary environment. Everybody feels it, but nobody is calling it so far. Yeah. From my point of view, I really like those long-term charts because I'm always very cautious when it comes to short-term forecasts. But for some sort of a positioning, I love those long-term charts, and we had kind of a similar chart in the previous gold reports, and this one is even longer, as you said, and it shows you that we're basically at the same levels of undervaluation since the year 1960, 65 it was, and since that commodities have never been that cheap relative to equities. Now, of course, commodities are also some sort of the flip side of the US dollar. I'm structurally pretty bearish the US dollar. And we all know that Donald Trump is pretty furious, and that he's putting enormous pressure on the Federal Reserve, and that he tries really everything to talk the US dollar down. And at some point, I think they're gonna succeed. Now, when I talk to institutional investors like pension funds, like high net worth individuals, private bankers, and so on, their commodity allocation is zero. They don't care about commodities. Gold, for some of them is interesting, but commodities is definitely something that is not a mainstream investment at the moment, and that makes me even more confident. And as you can see here, we're radically undervalued. We're way below the long-term median. We're far away from any overvaluation, and this in combination with this extremely negative sentiment, that's a pretty good sign. And if we compare the last two phases in which commodities were so extremely cheap compared to equities, and then enter the secular bull market, which was the 60s, and then basically the 2000s, there were some lots of similarities. In the 70s, the foundation of the gold bull market and the commodity bull market, or the US dollar bear market, was of course already laid in the 1960s. So we've had this pressure building up, to go away from the Bretton Woods Agreement. We had exploding budget deficits. We've had a very, very strong stock market, the Nifty 50 and so on. And then the 70s were the decade of gold and commodities and the weak dollar. And in the 2000s, it was a bit similar, I would say, because 1998, 1999, oil was trading at $12 a barrel. There was extreme pessimism in the sector. Everybody was crazy about, all the dot-com stocks. We've had extremely aggressive monetary policy by Alan Greenspan, and this laid the foundation for the bull market in commodities and in gold. So there's lots of similarities. History repeats, and that makes me pretty confident going forward for this really hated asset class.
Yeah, I definitely agree. When you look at the chart, it's obviously this can last a while where commodities can be radically undervalued, and we've been in a situation now for about 4 or 5 years where that's been the case. But yeah, we've obviously laid a very good foundation for the potentiality of commodities to spring forward and overshoot sometime in the coming decades. So I definitely agree with your long-term positioning and having confidence on the longer term for commodities. Moving on to slide 3, the third one that I had sent to you. Well, this is just I think what most people in the gold market, they really understand this once they've been in the market for a little while. Maybe when they're first coming into it, they don't truly understand how the gold price discovery mechanism works around the world. But this chart does a really good job of showing some of the largest gold trading venues by volume in billions of dollars in 2018. I believe, is this daily volume that you're showing here in this chart?
Yeah.
Wow. All right. So on the far left, obviously we have local London, which it's rather complex. It's not as simplified. I think COMEX is a little bit easier to understand. Local London, myself, I sometimes get confused by all the different things that go on there. But the amount of notional trading that's going on between local London and COMEX is really, I would imagine, the main driver for what you see day to day for your spot price of gold, and therefore for what you pay for bullion typically. So I found it very amazing. It's always interesting to sit there and just think about daily how much gold bullion is pulled out of the ground daily by miners around the world, and how much is being hedged maybe by sophisticated bullion dealers or various people, who are investing. Maybe they're doing some type of different trading. But ultimately, there's absolutely no way that there's any point for there to be $28 billion traded daily on the COMEX or 100 billion or more on the local London. To me, it just sounds like we're obviously being led around the world by derivatives, essentially.
Yeah, but I think that's not only the problem in the gold space. That's a problem that we're seeing all over the world, and my kind of solution or my answer is that this is, of course, all those derivative trading activities are also influenced by interest rates that are just too low. Because if you've got significantly higher interest rates, it also means higher opportunity costs and so on. And then there would be probably significantly less speculative activity, and you cannot lever up your positions that aggressively. When it comes to gold, it's obvious. It's one of the most liquid assets, or let's say currencies, and this is something that many people also kind of underestimate, the sophistication and the size of the market, the paper market is definitely something that makes it interesting for institutional investors and so on. The question is, if you really want to have gold as some sort of a monetary hedge, do you rather want to have it physically, or do you want to have a paper contract? I would rather go for the physical. Our clients, of course, always tell us there's basically two motivations for buying gold. You can speculate on rising prices, or you can regard it as a hedge against high inflation, against monetary reform, against whatever is going to happen, financial repression and so on. And then, of course, you want to have physical gold. And what we're seeing, this is really a big trend. 70% of physical demand is nowadays coming from emerging markets. That's a huge trend, and therefore for us it was important to publish the report also in Mandarin, as you've mentioned, because it's such a big and important market nowadays. And talking to the Chinese, they don't care about daily price fluctuations. They know that they're in for the long term. They know that gold over the next couple of years will probably significantly outperform most other currencies and most asset classes, and gold always goes where capital is built up, where there's entrepreneurship, where there's prosperity. So it's flowing from the Western countries to the Eastern countries, and that's a really big trend that we're following for a while now.
And Ronnie, and this is just recent news. I saw that the ECB, like roughly 21 central banks, signed off on the fact that they don't need any more agreements now for gold sales. So it's effectively saying anyone selling gold right now is obviously not being a prudent fiduciary of their gold stocks. So I think it's pretty easy. Everyone can kind of agree in the ECB that, no one's going to be selling gold. If anything, perhaps maybe some will be buying gold. I wonder what you thought about that little news that came out last week.
Well, the CBGA, the Central Bank Gold Agreement, I mean, they basically came to that agreement after Gordon Brown dumped, at the very worst point, dumped most of the UK gold. And then I said, okay, we're going to make a limit. At the beginning, I think it was 500 tons per year, and they lowered it to 400. But in this environment, basically most central banks were in a selling mode, and then at some point they stopped selling, and now there's even in Europe, in the European Union, there's countries aggressively buying gold. So last year we had a record high amount of central bank buying, and for example Hungary or also Poland were aggressively buying gold. And I think it's not only the fact that they're buying gold, it's also the fact that they're repatriating physical gold holdings from the UK back into their borders, into their countries. I think that's a very strong sign, and it shows you this loss of trust that we're seeing on an international level at the moment, and this loss of trust that we're seeing in many areas of life nowadays, and therefore was this erosion of trust was also the leitmotif of this year's report. And I think it's important because everything in our lives, be it in business, in private life, with your partner, with your family, and also of course when it comes to money, everything is built on trust. And the interesting thing about trust is it's very asymmetrical, so it takes months, years, decades, centuries to build up trust, and then within one moment there's a loss of trust happening. So this is something that we're following very, very closely, and I think this trend to some sort of a deglobalization and old alliances being questioned, that is really a trend that's a secular trend that is also pretty worrisome.
Yeah. And now talking about that European gold agreement, there was sales roughly of 400 to 500 tons per year. Just looking at the chart that they had published on their website, I believe
Yeah.
it was something like 4,000 tons had been sold from roughly 2000 to 2011. I found it kind of interesting because, obviously we're thinking about how derivatives kind of wag the dog of the price. But the fact that you could sell about roughly just over a year's worth of gold supply into the market in roughly a decade's time, and you still have a raging bull market going from 250 up to 1900 in US dollar terms at least. And now, ever since, the price has obviously been kind of sideways and building a base for the last 6 years. Whereas it looks like you said, a lot of these countries are now taking gold physically and taking it to their home nations, which is a much stronger position than perhaps where they were before. So it's very,
Absolutely.
very interesting. And the 4,000 tons being sold over the last decade before this one kind of deals with the next slide. The total gold reserves held in China estimated in tons. You have a chart here from 1994 to 2018. And I'm guessing a lot of the 4,000 tons that Europe sold, a big amount of it probably ended up right here. And it looks like in 2018, you guys have roughly an estimate of around 22 to 24,000 tons of physical gold sitting in China. So I wondered, perhaps, what you've been thinking. Obviously, their central bank has been showing lately a little bit more. Every little bit, every few months they come out and say we bought a little bit more, a little bit more. So they've been a little more vocal of late, talking about how much more they're putting into their official reserves.
Yeah, and I mean that's no coincidence. Yeah, that's definitely, this is a sign. Yeah, this is something. Okay, I don't know, Mr. Trump. We're permanently buying gold. We are not reinvesting in U.S. Treasuries anymore. So I think the significance of those updates, it's you shouldn't underestimate it. And we all know that the official numbers are probably way too low. I think there is very, very good estimates that the People's Bank of China owns significantly more gold than they officially publish, and there's basically 4 different institutions that can officially buy physical gold in China. But it's also it's not only the official reserves. It is also, of course, we shouldn't forget that China is now, for a couple of years now, the biggest gold producer, and no ounce of gold leaves the country. We've had very interesting discussions with Chinese mining companies, and they're very aggressive. They're opening up mines, but also offices all over the world. They're building up refineries, smelters. So it is definitely a very important industry for them. And then there is Chinese individuals, and if you travel around in China and talk to people there, it is pretty obvious that gold for them is extremely important. We've seen that jewelry consumption last year reached a 3-year high of 650 tons. So we know that with increasing prosperity, there are higher gold purchases. We mentioned quite a lot of studies in the report. So I think the Chinese market is very important for the gold market, and it's not only China. It's of course also India. It is Vietnam and so on. But it's just a very, very strong long-term trend that is definitely different from this kind of fear trade that many people in the Western world are always mentioning. Gold as a hedge against, inflation, market collapse, and so on. We shouldn't forget that there's also this long, I think Frank Holmes calls it the love trade. Those Asian or Arabic countries that are growing and that have got a very, very high affinity for gold, and the physical consumption that we're seeing in those countries is just constantly trending higher.
And the final slide that we got, you guys did a really good job here of boiling it down to its essence. John Exeter's pyramid, for those people who don't know who John Exeter is, he's a former Federal Reserve governor who worked with the Fed in the 50s and 60s, especially during the time of the London gold pool, where some almost 10,000 tons of gold, essentially the same amount that we confiscated in 1933, kind of leaked out the door under his watch as he was head of the New York Fed gold and silver operation. And so, he firsthand saw the attempts to control the price of gold, and it worked for a little bit until too much gold was going out the window, and then Nixon and had to stop all the gold flying out to France and other places. And so Exeter did a really nice job. I believe the original pyramid is sometime in the 60s or 70s. He may have drew that. But this is more of an updated version of Exeter's pyramid. If you wouldn't mind, Ronnie, give us an explanation of this pyramid that we're looking at, this upside down pyramid that we're looking at.
Yeah, I mean, for us, it was really really interesting because you sometimes see Exeter's pyramid, but there is not too much of official writing from John Exeter, and then through a friend of mine, John Butler, we met Barry Downs, who is John Exeter's son-in-law, and he basically knows everything about his father-in-law, and we did an interview with him, and he explained, also the misconceptions about Exeter's pyramid, and John Exeter basically said that there's this inverse pyramid, and in times of crisis, of volatility, it goes from the upper layers of this inverted pyramid, where derivatives at the moment, it goes down into global real estate, then global debt, the money supply, stock market, currencies, base money. And then many people think that on the bottom of this inverted pyramid, there's gold. But John Exeter originally said that all currencies are IOU nothings, and that therefore gold should be not a part of the pyramid, but outside of the pyramid. And this is something that we explained extensively in the report, because all levels of Exeter's pyramid, they include debt. So as you know, even cash is a liability to the central banks, and gold, of course, is nobody's liability. So for us, it was important to also explain a bit what Exeter actually did. He was very, very influential back in the days. He was also, I would say, good friends with Ludwig von Mises. He was quite good with Paul Volcker, and advised Paul Volcker. So he's a very, very interesting character that most people don't know too much about, and therefore we wanted to write a chapter about him and his really his wisdom, I would say.
Yeah, so the inverted pyramid is essentially a pyramid of the top of the pyramid being perhaps the most risky counterparty laden assets that potentially, when there's a financial spillover event, when everyone wants their money, essentially, when everyone wants their money back, it kind of rolls downhill from the riskiest, the top area of that pyramid, all the way down to the least risky assets. And potentially in that frame of mind, the least riskiest asset is the one that has virtually no counterparty risk other than someone stealing it, is basically bullion, whether it's gold. Gold is money to the monetary system, and that's obviously proven by the central banks buying it. Others could argue perhaps other precious metals like platinum or silver, they can hold their value in those types of situations too. But thank you so much for showing this pyramid. I think this pyramid does a really good job of illustrating how different gold is compared to other assets.
Yeah, thanks a lot, and we're those things are important for us. We're writing this in Gold We Trust report because it is basically I often feel like a distillery, because we are reading so much every year. We're talking to so many different people. And therefore, we try to really distill what's going on in the market, but we also really want to educate and inform and prepare our readers. So stuff like that, I think it's really important to understand the big picture, what's gonna happen in a liquidity crisis, what's the foundation of such a pyramid like Exeter's pyramid. Yeah, and that's just something that we really enjoy doing, and that is really important for us.
So, Ronnie, I'm going to backlink the free In Gold Trust Report link in our show notes. But if you could give people a verbal of how they may be able to find it, what's the easiest way they could reach out and get that PDF?
Yeah, well, it's available for free in a extended, like the triple X version, but also there's a compact version which is still 100 pages. You can download it for free on our webpage, ingoldwetrust.report. You can download all other In Gold We Trust reports, all other 12 previous reports that we have written, everything in German and in English, and nowadays, since 2019, also in Mandarin. If you want to learn more about our other publications, we've got the Crypto Research Report. I wrote 2 books. And if you want to learn more about the products, the funds that we're offering, have a look at incrementum.li. LI, which stands for Liechtenstein, where our company is based. And yeah, otherwise you can also follow me on Twitter. It's my handle is Ron Stoeferle.
Great. So, Ronnie Stoeferle, I hope I pronounced that closer. I really do appreciate you coming on our podcast and giving us an update with the latest In Gold We Trust report. And hat tip to you and your team. You guys do a wonderful job every year coming out with just great report. It's always something that people who are interested in the space look forward to seeing. So, thank you so much.
Thank you. I really appreciate it.